Hello and welcome to AI Market News by LM. Disclaimer, this video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, let's get into it. We are smack in the middle of a major global risk-off situation today, Friday, October 17th. And it looks like, once again, the tremors are starting in the U.S. credit system. We saw that gauge of U.S. regional banks plunge yesterday, what was it, over 6%? And that fear has definitely gone global. So our mission today is really a full diagnostic, understand these shock waves, and crucially, track where capital is running for safety.
Absolutely. We're essentially tracking the mechanics of fear, if you will, across three main areas. First, the source. We need to dive into this U.S. banking turmoil, those cockroach fears people are talking about. Second, how markets are reacting the flight to treasuries, gold, and, interestingly, that resilient tech trade. And finally, the global picture. Key currency pairs like the euro-dollar, dollar-yen, and how central banks are responding, or diverging, really, in this stressed environment.
Right. Let's jump straight to the source then. This immediate panic, it seems to have kicked off with a relatively small write-down from Zions Bank. Help us understand why $50 million suddenly triggered such global anxiety. European banks having their worst day since August because of this.
Well, the panic wasn't strictly about the size, the $50 million itself. It was about the nature of that loss, and crucially, the implication of contagion. Zions disclosed that loss was tied to alleged collateral fraud in distressed commercial real estate, CRE. The really toxic detail, the kicker, was that Western Alliance almost immediately confirmed they had exposure, similar loans, to the exact same borrower.
Ah, okay. So not just an isolated issue at one bank. It was confirmation that potentially fraudulent debt was shared across multiple regional players. That just screams systemic vulnerability, doesn't it?
It does. Investors saw that and instantly thought, okay, this exposure isn't contained. And this is hitting at a really bad time because the whole CRE sector is facing this huge refinancing cliff. If banks suddenly can't trust the collateral backing these loans, well, the whole valuation structure is threatened. The potential losses could be astronomical.
And the market reaction certainly backed that up. It wasn't just noise. Deutsche Bank down 6.5%, Barclays 5.5%. Yeah. Those are serious hits in Europe. And even the big Wall Street names, BofA, Morgan Stanley, Citi, they were all pointing lower in pre-market trading too.
It kind of brings us back to that unsettling warning we've heard before.
You mean Jamie Dimon's cockroach warning?
Sure. Yeah. His point was, you know, in the credit world, if you spot one problem, one cockroach, it probably means there's a whole infestation lurking unseen. The real fear here is that investors, and maybe even the banks themselves, just don't know the full extent of the risk exposure. Especially, and this is key, in the multi-trillion-dollar private credit market.
Private credit. Okay, maybe unpack that a bit for us. Why is the opacity there such a specific source of dread right now?
Right. Think of private credit as, well, a kind of shadow lending system. It's corporate debt, but financed outside the usual highly regulated banks, often by private equity funds. It absolutely ballooned during the easy money era, partly because of fewer regulations. So these loans aren't publicly traded, they're not as rigorously monitored as bank assets. If there's a problem, like this alleged collateral fraud, losses can stay hidden longer, and the potential systemic impact, it's just completely unknown. That uncertainty is like pouring gasoline on the fire.
And we're seeing that uncertainty reflected pretty clearly in the main fear gauge, right? The VIX.
Oh, absolutely. The VIX, the CBOE Volatility Index, it's continued its sharp climb. It's closing in well above 25 now. That's a level of sustained anxiety we really haven't seen since, what, back in April.
A VIX over 25, yeah, that tells us investors aren't just nervous. They're actively hedging, preparing for some serious chop, potential big moves down.
Precisely. So the big question becomes, where is all that scared capital actually flowing?
Okay, let's trace that flight plan. U.S. equities are clearly feeling the heat. S&P futures were pointing towards a 1% drop earlier. But here's where it gets really interesting, almost confusing. The tech anomaly.
It is truly anomalous, isn't it? You have the foundational financial plumbing, screaming trouble, yet the AI-driven tech trade, particularly the big names, seemed almost, well, impervious yesterday. The tech sector actually gained over 1%. NVIDIA was a big leader, top performer, and that came right after strong earnings and guidance from players like TSMC, too.
Hold on, though. We just laid out how the core risk is credit stress, opacity, potential fraud. If the whole financial system is under duress, how can these tech giants they rely on VC, stable markets, global supply chains, How can they be so disconnected? Is this just momentum chasing, or is there genuine insulation?
That is the critical question the market's grappling with right now. The bulls, they argue AI demand is this massive secular trend, right? A structural shift so powerful it just overrides these cyclical credit wobbles. But the skeptical view, and it's a strong one, is that this is just the last pocket of momentum money left standing, a very concentrated trade that eventually has to confront reality if the overall cost of capital spikes or, say, consumer credit really tightens up. It's the key fault line in U.S. equities today.
That's a really clear way to put it. Okay, let's pivot to the traditional safe haven, the bond market. The capital flight here seems undeniable.
Oh, treasuries are what we call well bid, meaning demand is very high, pushing prices up, yields down sharply. The benchmark 10-year yield, it's now slipped below 4%. That's a really crucial long-term psychological level. When the 10-year breaks below 4%, it strongly suggests the market is prioritizing safety, maybe anticipating economic slowdown over inflation risk.
And the move in the shorter end of the curve is even more telling about the urgency, isn't it?
Look at the 2-year yield. It has sunk, really sunk, 20 to 25 basis points just since last Friday. Now, for context, 20 basis points in a week. That's an aggressive sprint towards expecting a major policy shift from the Fed. And this move is feeding directly into the Fed watch tools people follow. Traders are actively positioning options, betting on a potential, maybe even a boosted 50 basis point rate cut between now and year end.
Wow. So the market isn't just expecting the Fed to react anymore. It's actively pricing in serious distress, effectively trying to force the Fed's hand, telling them they need to ease policy much faster than previously thought to keep the system stable.
That's exactly the signal being sent. And if we look at commodities, gold's rally also speaks of volumes about this deep safe haven anxiety. The bid there remains strong, up another 0.7% today, closing in on $4,400 an ounce. It's on track for its best week since, believe it or not, 2008. That reflects both the credit fears and, let's be honest, concerns about the massive U.S. deficit. Conversely, look at oil. Still stuck around $60 a barrel for Brent, set for 3 straight weeks of decline. That suggests oversupply concerns and recession fears are hitting demand expectations harder than any geopolitical risk premium right now.
And Bitcoin, often touted as digital gold, seems to be missing the safe haven party entirely.
Yeah, it's acting purely like a risk asset today, currently trading, 13% below its recent highs. It's just not offering that systemic defense that treasuries and gold clearly are in this environment.
Okay, let's shift focus overseas, the Forex market and the central bank divergence idea, starting with your Gray's D. The euro's holding around 1.17. Now we have global risk off, which usually boosts the dollar. Yet, paradoxically, the dollar index is set for its worst week since July. What's driving the greenbacks selling here?
It's likely a combination of factors. The dollar might have been simply overbought coming into this, but also that aggressive pricing of Fed rate cuts we just discussed, the 50 basis point expectation that puts direct downward pressure on the dollar. The market's basically anticipating that if the U.S. faces a major credit event, the Fed will have to ease policy much more aggressively, much faster than its peers like the ECB. That weakens a currency outlook.
And that divergence seems particularly sharp when we look at Asia, specifically with the Japanese yen.
Absolutely. The yen is gaining strength. It's pushing down towards the high 149s against the dollar. It's benefiting from 2 things. 1, the classic safe haven demand we're seeing everywhere. And 2, some pretty hawkish comments coming out of the Bank of Japan. Boje Deputy Governor Uchida basically reaffirmed they're still on track to tighten policy, to hike rates, if their economic and price outlook holds up. So they're signaling movement in the opposite direction to what the market now expects from the Fed. That's a powerful catalyst for US DJPY downside.
Meanwhile, in Europe, the Bank of England seems to be walking a very difficult tightrope. We heard from their chief economist Hugh Pill, who's generally seen as a hawk on the MPC. He urged caution on rate cuts.
Yeah, Pill's message was quite clear. He's warning policymakers not to ignore the persistent underlying inflation pressures, even as they acknowledge the downside risks, from a weaker labor market or this potential contagion from the U.S. He's stressing they need to avoid cutting rates too quickly or too deeply, which puts him somewhat at odds with others perhaps more worried about recessionary signals.
Okay, and just to round out the macro picture, let's check the economic calendar. Based on the data from investing.com, this morning, Friday U.S. time, we got the Euro area final CPI for September, came in right on forecast, 2.2% year over year.
Right, so a steady inflation read for Europe. But the real focus today, data-wise, remains firmly on the U.S. Later this morning, 9:15 a.m. ET, we get U.S. industrial production numbers, and investors will be looking at that through one specific lens. Is the U.S. real economy actually slowing down enough to justify those aggressive Fed rate cuts the bond market is already demanding?
And layered on top of all this economic anxiety, we also have some significant geopolitical and trade developments adding to the uncertainty, right?
Definitely acting as overhangs. First, on the Russia-Ukraine front, there's clearly diplomatic movement happening. President Trump and Vladimir Putin have apparently agreed to a second meeting, this time in Budapest, within 2 weeks. This followed what was described as a very productive phone call focused on ending the war. And this comes just ahead of Trump's planned meeting with Ukraine's President Zelensky today. So, intense diplomacy underway. Could reduce geopolitical risk, or, depending on outcomes, maybe even heighten it. Markets are watching closely.
And shifting to trade policy, some potential relief for U.S. automakers.
Yes, it looks like the White House is set to ease some tariff pressure there, specifically granting a 5-year extension on an arrangement allowing reduced duties on imported parts for giants like Ford and GM. The goal seems to be reducing input costs, providing some supply chain certainty, trying to support that domestic manufacturing sector, which has been squeezed.
Okay, and one last piece, China. Flexing its muscle in a way that could directly hit that impervious tech sector we talked about.
Yeah.
Rare earths.
This is potentially huge. China controls something like 90% of the global refining capacity for rare earth elements. These are materials absolutely essential for high-tech manufacturing, defense, AI components, specialized chips, magnets, the whole 9 yards. China's implementing new export controls involving pretty intrusive licensing requirements, and that's raising major alarm bells, particularly in Europe, worrying about hits to defense, AI, automotive sectors. If supply gets constrained or costs spike, well, that could seriously undercut the input costs for companies even like NVIDIA, challenging that whole insulation narrative.
Okay, let's try and tie this all together in this deep dive for Friday, October 17th. The big theme seems to be a sudden shock, originating in a corner of the U.S. credit market that instantly went global. Why? Because of fear of the unknown, that cockroach potentially lurking in opaque areas like private credit. And the immediate reaction. A massive defensive pivot into bonds and gold.
That's the core story, and the key takeaway, I think, is the message the market is screaming at the Federal Reserve. By pricing in such a large, maybe even boosted rate cut so soon, the Treasury market is saying loud and clear, financial stability risk, the fear of the plumbing seizing up, is now a bigger concern right now than sticky inflation. Which
leaves us with a really fascinating, maybe even unsettling, final thought for us all to consider. We have the bond market pricing in financial distress severe enough to demand major Fed intervention. Extreme risk-off signals there. Yet at the same time, the multi-trillion-dollar tech sector, powered by this incredible AI enthusiasm, seems fundamentally disconnected from that fear, almost defiant. So the question is, how long can that rally in the big U.S. equity indices, the S&P 500, the NASDAQ, stay divorced from this growing anxiety in the financial system's foundations? Or are the bulls right? Is this problem genuinely contained? And is the AI growth story just that powerful? That's our deep dive for today. Thanks for watching. Don't forget to like and subscribe.